Hi everyone, welcome back to Be Rich. Today I wanted to talk about how we managed to tame inflation. Is this the worst behind us? Or because that's what everyone in the market seems to be feeling, at least based on the recent job reports analysis. Recently, a jobs report came out showing that a gain of 175,000 jobs was below what was expected at 241,000, marking a significant data point indicating the economy is slowing down, potentially easing inflation. Despite this, the 3 and 6 month averages show steady but a slightly increased trend in job creation. So it is not here nor there kind of a report. That coupled with Warren Buffett coming out and saying that he sold off some Apple shares in the first quarter and the cash reserves have increased to a record high, though he kept saying he's not looking at cash and treasuries, it seems that Berkshire Hathaway seems to be not upset about the fact that they can buy some short-term treasuries and get a return of 5% or more, and that seems to be influencing their decision for this. That there's an opportunity to take some cash from the US treasuries at these high interest rates, though Buffett doesn't seem to be saying that. What this leads to further analysis is the wage trends and the economic implications. There's a consistent trend that cooling wage growth over the past 3 months, then lower wages growth is seen as crucial for achieving this inflation target, which the Fed is hoping on. But this nominal growth data remains below the high trends of the mid-2022s. So if you look at the aggregated weekly income, that remains unchanged for April 24, marking the weakest month of growth since Feb 21. The market has taken all this information as a positive thing and it sees a potential future rate cut by 2024. Kind of reminds me of last year when we were talking about the rate cuts coming from Jan. And when we were in Jan, we were saying this year is going to be full of rate cuts. The market was reacting to that and pushing stocks even higher. But this persistent inflation might drive more on structural changes. The argument is these inflation, which we're seeing so persistent in the US, is not because of wages and jobs. It's more of a structural change in the economy and also supply side issues and than consumer demand and challenging of effective rate adjustments alone. Meaning the Fed cannot really address these issues through rates. Meaning there's structural change happening in the economy and supply side issues because of what's happening geopolitically and macroeconomically and as a worldwide trend, what is happening is influencing all this. So commentators like Mohammad Elaran and Tej Parekh have been suggesting that aggressive rates increases may not address the root cause of this inflation, which is based on supply chain disruption and structural economic changes. They both argue that aiming for a 2% inflation target may cause unnecessary economic damage, while modern service-oriented businesses are less sensitive to rate changes, is what they further on go on to say. Meaning, the Fed keeping these interest rates at these levels may do more harm than good to the economy and that to the global economy, and them trying to control inflation through this tried and tested methods may not work because interest rates cannot have an effect on something known as supply chain, structural changes, global geopolitical situations, and even service-oriented businesses, they say, don't seem to be affected too much by inflation rates. So if you look at it from that point of view, their argument does have some merit. Will this lead to rate cuts? I do not know. Will this lead to no further rate rises? I do not know, because these systems, like I was talking previously in another video, are far more complicated and they're far more opaque than we seem to perceive. Yes, we can look at this and try to understand this. It's like having a patient who has multiple issues and has multiple organ failure, and we have specialists for each organ talking about it. But though we have multiple doctors talking about multiple issues and giving their opinions on each what we should do, each treatment contradicts another doctor's point of view. So as a whole, we get to understand we have to pray to God. And that seems to be pretty much the way it seems to be going. If you read any report that comes out, we are getting paralyzed with paralysis to analysis, as they say, and we don't seem to be making any headway in this. And I don't blame them, because sectoral performances, if you see now what is happening in the US is investors are becoming more and more preferring, that is, more and more utility sectors, defensive stocks such as consumer staples, and those have been performing much better recently after a period of underperformance a couple of years back or a year back to now, where they seem to be outperforming, this shift may be an indicating that investors' risk appetite is not there as it was before, and this might be a potential sign of an economic slowdown. So basically what this means is, if you use any of this trying to predict what is going to happen, it is next to impossible. You're much better off trying to see value in what you're investing, in what you're buying. And if there is value and you're looking at it in the long term, you will be a sure shot winner compared to trying to look at it in the short term and trying to predict price swings and price movements and do trading in that. It's going to burn you. This I say because in India, there's been a growing trend amongst new investors, especially young investors, in trading in futures and options. Yes, our markets are very different. The way our future and options are priced compared to the US are very different. We're not the same. We're not comparing apples to apples here. I do understand that. But the volume and the volatility and the exposure some of us are taking is pretty scary. And I would strongly advise you to think twice. So if an expert, someone who studied the subject, who studied this for years, is finding it hard to look at this and predict where we are and where we are going, us laymen looking at this and trying to guess work this is definitely not advisable. It's like walking into a cockpit when you're 40,000 feet up in the air, and then you're forced to take over and you look at a panel full of buttons, and then you think, okay, what am I going to do? That is where we laymen investors are at this kind of a junction in the markets and the world economy put together. So I would ask you to tread with caution in your ideas, in your adventures in the stock market, be it in India, be it outside India. Do have someone who is seasoned, who's a registered advisor, advising you on what you're doing, and because to understand your own risk appetite, to make sure you're heading in the right direction. I hope you found this video informative and entertaining and brought you some awareness on inflation and how inflation data can be misread sometimes or can lead to no real analysis of any sort. Thanks for watching the video, and I'll see you in the next one soon. Bye.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.